We're now going to talk about productivity, and we've got 4 people here who you can read about in your programs. We've got a Nick at each corner, as it were, and Rebecca is here and Tara is there. That's just so that those of you who don't know them by sight can work it out for yourselves. And we're going to talk about productivity, which is something that each of them comes to from a slightly different angle, I suppose. Nick Crafts comes to it partly from the area of economic history. Rebecca, perhaps you've done more work on labour productivity than most people in the room have probably done. Tara, I know you've been interested in innovation and in tech adoption. And Nick, uncertainty, as we know, is now one of your theme songs. So, with that in mind, I thought we would put up a rather wonderful slide which shows you pretty tersely what's been happening in the main parts of the northern industrial world productivity and where the UK is in all of this. And I'm going to toss a couple of questions at all 4 of these people, and then see if you're starting to have any questions, if we can get a wider conversation going in the room on this really fascinating subject and really fascinating set of numbers. And I thought I would just start off by asking, and start with the economic historian on my right, whether the drivers of productivity have changed in the recent past. And you can define recent as you like. So, Nick, your recent may be further back than those of the other panellists, but have a go.
I tend to take recent to be post-industrial revolution. Perhaps I'll define it more friendly way today. Okay, I jotted down 2 or 3 points in response to this, Francis, so let me quickly rehearse them. Firstly, I think it is important to note, and this slide tends to show it, that the productivity slowdown we're going through is pretty much OECD-wide. The incidence varies a bit, but it's generally there. Also, and I think this is worth bearing in mind too, it seems to have begun, I think if you look carefully, before 2007-8, so it's pre-financial crisis to an extent, but then obviously substantially more. Secondly, I think any economic historian is likely to say that technological change is always the long-run fundamental factor which other aspects of the economy react to. It's certainly true, however, that some countries exploit the opportunities better than others. In the context of technological change, then, I think we're seeing a waning of the ICT growth phase. And ICT had a big impact in the decade or so before about 2005. That again, I think it can be seen in other countries, not just in the UK. So we see technologies come along, we see strong growth in some phases of that. And arguably, and this is much more conjectural, if you follow those 2 thoughts through, we might be looking for something which would be succeeding, coming along after ICT. That's likely to be AI, robotics, something of that sort. Perhaps we're living through a kind of productivity paradox where we can see the excitement of the new technology on the horizon, but its economic impact is still, at best, very modest. I'm obviously qualified to be a grumpy old man. I'm far in excess of the minimum age for that. I notice that the grumpy old man who gets the most attention these days is Bob Gordon. Let me simply say I really do not buy his argument that all the great inventions are in the past. We could come back to that if we want. Is it a real slowdown? Might be your next question. Economic historians are always very nervous about measuring growth for all sorts of obvious reasons. The index number problems can be big. The GDP deflator can be hard to measure, all those sorts of things. My own take here is that measurement errors probably don't explain very much of the slowdown, errors in the national accounts or whatever, but I do think we always tend to underestimate the rate of growth. But I think we were underestimating it before the recent slowdown as well. So that's a slightly different issue. As far as the slowdown is concerned, and let me then put my economic historian's hat on, I think there are various ways in which you can say the current slowdown in the UK is unprecedented, at least in the period since, say, the mid-18th century. If you look at the way the ONS describes this, they'd say we're now about 20% below the level of productivity that we would have if the pre-2008 trend had continued. If you try and do that exercise for the past, estimate the trend and then look at divergence in key episodes, this divergence from the previous trend looks to me to be about twice as big as any other that you can find in the previous data. So it is unusual. And that might, in a way, mean something has changed, and we could come back to that. One last point, when people estimate those trends, and some people would carry on the trend estimation right up to the present day, rather than stop 10 years ago, if you do that, you're probably going to get an answer that the trend rate of productivity growth is very low at the moment. Let me say I'm not at all convinced that's a good guide to the future. I think TFB growth 10 years ahead is actually extremely unpredictable. And so if you are a techno-optimist, let's say, I wouldn't let the econometricians put you off too much. So the slowdown is real, but arguably not so permanent as some people believe.
Rebecca, would you share that modest optimism?
Well, I starting with the same point you made, Nick, I think there probably is some of this waning of the ICT boom, and potentially we're waiting for some diffusion of technology with some consequences for productivity in the future. I guess one thing that I would highlight is the shift in the production factors that drive productivity growth in recent years, or the last 15 years even. And the shift that I'm talking about is the shift from tangible to intangible capital. So this is something that a number of people in the United States have looked at and started to measure. And although there's lots of difficulties in actually measuring these things, their conclusion is that we're investing as much in these knowledge-type assets as we are in physical capital. And I guess, so these things are really important. And I guess one of the things is that I think maybe we are missing something. So I agree that this isn't a mirage of some kind, that measurement is not going to explain away this slowdown that we've seen, but I do think there's probably quite a few things that we're missing in the data. So if we think of intangibles, typically we've been talking about things like R&D, software, databases, that kind of thing. There's a sort of standard taxonomy that Carol Corrado developed, and organizational capital as well. If we think of those buckets, if you like, they're only getting bigger and broader in scope. So data is having a completely new function. We do ask people questions about, or companies questions about their databases, but it's very likely that we're underestimating the investment in those assets and their uses in driving productivity. If we think of the value in many companies these days, it's in their organizational structures and their networks, software of various kinds. Again, I don't think that we're capturing all of those things. So while I agree that this isn't some kind of mirage and unlikely to be explained away by things that we're missing in the data, I think that there is something that's worth exploring there. I mean, I guess one of the difficulties in trying to understand how we can improve productivity from where we are is that it's quite difficult to understand how these things that we're not measuring properly actually influence productivity. And that's not just because we don't measure them very accurately, it's also because there's a sense that the way in which they add value to companies is different from traditional production processes. So there's increasing returns, externalities of various kinds, And so it's difficult to pinpoint where should we help businesses improve productivity. So if you look at the distribution of productivity across businesses, and this is something the OECD has done a lot of work on, and they've shown that over the last 15 years or so, that the productivity distribution across companies has fanned out. And we don't know a lot about those companies that are doing well and which are basically driving the economy. But we can look at some of the information we have and link various data sets together. And what's quite apparent is that the companies that are doing the best, they do invest in all of these things, in the software, the databases, the R&D, all of these assets. So it becomes very difficult to pinpoint which of these is the answer. And I guess, so there's that aspect as well. They also tend to hire the more skilled workers, these businesses. So they hire workers who are working in IT occupations, R&D occupations, skilled occupations. And we know from, for example, the skills survey that Alan Felsted's done and Francis Green, that these workers, they've done a cut of the data looking at these different types of workers in these intangible asset type occupations. And they're the ones who innovate in their job. So they get asked questions about, do you innovate on a daily basis? Do you come with new ideas? Do you participate in groups, etc.? And it's these workers who tend to innovate, and they're in these high-performing companies. So if we're thinking about the long tail of low productivity firms, I think it's very difficult to think about where do we start, basically.
Interesting. Tara, technology seems to me to be quite an integral part of what we're talking about. I think everyone in this room has probably felt that their technology, their productivity has increased spectacularly since 2007 because of just one innovation that, as Steve Jobs said, changes everything. But do you come at that from a different angle?
Yes, in some ways, I'd like to build on what Rebecca was saying. All of these different factors of production are obviously incredibly complementary, and that's why we end up having these sort of winner-take-all phenomena, and it's important to look at distributions. But if the original question is, have the drivers of productivity changed? Then I guess the drivers of productivity have always been basically capital, quality of labor, and total factor productivity. And if I look at that more from the point of view of like a business or a policy language, then we're talking about infrastructure investment, skills, and innovation. I can see Mike there in the audience. I think years ago when we were both at BIS, we concluded that if you try and understand why the UK is lagging behind in productivity, it's infrastructure, skills, and innovation. So those kind of broad themes haven't changed. I think what we have learned over the last several years is to not just look at things in aggregate, but actually start to disaggregate things. And on all of those themes, there are some very, very important nuances. So on infrastructure investment, for example, it's not any kind of infrastructure investment that's going to drive productivity. I used to work at the Department for Transport, and it's very clear that if you relieve bottlenecks and reduce congestion, that's going to have a bigger impact on productivity than if you just kind of throw money kind of more evenly across the piece. Equally, there's been a lot of debate about broadband and whatever, and it's not at all obvious that it drives productivity if it doesn't come with the requisite complementary skills. And so on skills, a lot of the kind of policy debate tends to focus on higher education. And in fact, 50% of people under 30 in the UK are now expected to go and do a university degree. But then when you look at the quality of graduates on PIAC surveys and others, UK university graduates have lower skills in literacy, numeracy, and problem solving than on average in Europe. So it's not about just quantity, it's also about quality. And of course, we see a shocking reduction and lack of in-work training. 19% of people every year actually participate in in-work training in the private sector. Public sector does much better. So it's not a surprise to me that the kind of human capital that we have in our workplace is perhaps deteriorating, but certainly not brilliant in driving productivity. And then finally, on innovation, the adoption innovation is much slower than we all think. As an economist, you think, once something's been invented, surely competition will drive everybody else to adopt it. Well, no, really basic technology like ERP or supply chain management software or customer CRM software, customer relationship management software, only about 10 to 15% of UK businesses have adopted those things, which were invented 10, 20 years ago. And so when it comes to artificial intelligence or whatever, we're really only just looking at the top companies adopting this at the moment. So if we're worried about aggregate productivity, and I am worried about that, not just kind of firm level, then we also do need to worry about all those businesses that are not the best but in the rest.
Nick, anything you would add into all of this? Pretty wide sweep.
Given I'm last, I might be slightly controversial and argue I'm not sure there is so much of a productivity puzzle. So I'll explain what I mean, which is, if you look at this graph, the panel had some discussion beforehand over this. I don't know what to show. If you look at the graph, for us we can't really see it properly. If you look at the graph behind us, you can see that productivity in the US, in the UK, in Europe has been on a declining trend for quite a long time. In fact, it's been declining for about 70 years. So to my eyes, it's not so obvious actually that recent productivity growth rates are off trend. Now, two thoughts. One is, why has that trend been declining? That's less obvious. Coming back to what Nick said, it's not obvious also that low trend remains. So I think there's kind of one way to think about it. There's kind of two rough models. There's the kind of apple tree model whereby you pick the low-hanging fruit. That's kind of Bob Gordon. All the great ideas have gone. That might be roughly true over the period we've seen. R&D over GDP rates are going up, training's going up, education's going up, but growth is declining. So it's hard to think what else it is. But that doesn't mean that's going to be there forever, because coming back to the Industrial Revolution, that was an alternative model is standing on the shoulders of giants. So people invent new stuff. The iPhone makes us all so much more productive. In California, there's these guys called the Singularity Institute, and they say that computers will get so good that they'll invent new computers and the things will explode. So that was kind of like the Industrial Revolution. Productivity growth was close to zero before it, and then it starts to take off because people build on the shoulders of giants. So, if I was to extrapolate the next 10 years, I would just look back over what's happened for the last 70, and it predicts kind of declining productivity growth. So in some senses, it's not a puzzle as to why it's low. I think if I was to think about policy and drivers, very much linked to what Rebecca and Tara is talking about, one of the things I'd look at, I guess, from my own research is management. So for the ONS in the UK and with the census in the US, we've been collecting, I don't know, by now probably 200,000-300,000 observations of management data. With we have a big ESCO project on this in the UK, and you see a very strong cross-sectional correlation in management and productivity, and it accounts for maybe 20% of the cross-sectional variation. I suspect part of that slowdown is actually, if you look at management practices, there was a big revolution in the 60s and 70s, and the thing, like lean, they spread out across manufacturing, it spread into retail. Most manufacturers and retailers are reasonably well run. So it's kind of, in the US, you visit factories, and they say it's like really hard to know how to improve. We've done most of the obvious stuff. But in terms of policy, there are clear parts of the economy where they aren't so great, like the public sector. Some of that is not fantastic. There's definitely a tail end. So I don't want to be too much, like the panel, I don't want to be too pessimistic. I'm not surprised by it. I guess my thought is if we want to, arrest the decline beyond hoping for luck, the other thing would be focus on, we discussed, technology and organizational capital, adopting best practices, which I see is very much related to improving management practices. And that's something we can affect through policy levers.
I must say, if you look at that chart, what you see is that the two big leaps in productivity were both immediately after very long and nasty wars, and it makes you wonder whether there's something that happens to a society at that point which makes it more willing to think anew about practices. And there's also a tendency. What's also interesting is that the decline is by no means confined to the UK, although what I was going to ask you next, in fact all of you next, was whether the UK's performance has been particularly dismal since about 2007, and if so, why that was. Maybe you'd like to start with that, and you can go back in the opposite direction.
I feel I'm a dual national. I feel a bit odd. I was talking to Tara. Tara knows much more about UK productivity than I do. But I'm British, and I guess you were born in Finland. So I feel really odd because I live in the US now, so I know. But
But you have a Scottish wife.
I do have a Scottish wife, and I was married in Glasgow, so we have a Glasgow.
I think we'll let you through the nationality barrier.
The UK productivity has been even worse than the US. So the UK productivity growth, we're looking at the ONS. The ONS release came out yesterday, and it's basically flat since 2007. I think, as much as I'm talking from work from the CEP, a couple of things I think are gone on. One is the US has some. The US looks like this, and the UK looks like that. I mean, the UK is just flatlined. It goes up and it moves sideways. The US is just slowing down. One thing in the UK that's interesting is real wage growth has been negative. So real wages, inflation has been higher since 2007 than nominal wage growth. And part of the story, I know John Van Reen has looked in the CEP, is just if labour's cheap, notice this is output per hour. This is not adjusting for capital. If workers are cheap, you just invest in labour and you don't invest in capital. So maybe UK TFP growth isn't as bad. And then the other thing is Brexit, but I don't think Brexit is pretty terrible for the next. The problem is the data probably doesn't quite cover the Brexit period, but I think the real wage thing, because the US has had real wage growth. I was, again, this morning looking at the data, about 1% a year, and the UK is about 0. So the British are basically pricing themselves and pricing capital out of work.
Immigration?
I mean, look, a success story. So David Autor in the US always makes this point that you can't have robot apocalypse and fears of productivity growth. In fact, we've had no jobs apocalypse. The UK has, amazing labour markets, really high level. I think it's one of the top amongst the OECD at labour force participation rate. So that's a huge success story. But the flip side of that is because effectively labour's cheap, we're hiring lots of marginal workers now doing not very productive stuff. So I probably have. Immigration, I'm not so much sure of immigration. I think it's just that, labour force participation is up and real wages are down.
Actually, I think now the over 60s.
I'm an immigrant, by the
it's
way.
It's the over 60s now, as far as I can see, all the net. But anyway, this is not what we're here to talk about. Tara, in spite of your non-British origins, what do you think?
Tara knows, I was just saying, Tara knows more about this than I do.
So we did a specific piece of research last year on UK productivity, looking very much what I call the second derivative, but I think in English you call it second difference. Right. In other words, not the change in growth rates, comparing 2010 to 2015 growth rates, which were pretty much 0.2 in productivity terms, to an earlier period before the financial crisis, 2000 to 2005, and trying to understand what might have explained the different growth rate, the drop in growth rates from about 2% to about 0.2% in those two periods. Immigration doesn't explain it because immigration was continuing to grow at about the same rate in both periods. So, it doesn't explain the difference in differences. What we found were a couple of things, and they are very similar to what you were saying, Nick, earlier. So investment in capital did drop dramatically post-financial crisis. The flip side of that is that hiring continued at a very robust pace post-financial crisis. So the capital per unit of labor dropped significantly. And so everything else being equal, you would expect that to result in a very much lower productivity and productivity growth rate as a result. What we did not find was any kind of sectoral or regional explanation. There are a lot of people saying, it was just a couple of sectors like oil and gas and financial services. Well, actually, every single sector, 83% of all the sectors experienced the productivity growth slowdown, as did every single region in the UK, actually, at the NUTS 3 level, I believe. So basically, there's something fundamental about capital versus labour. And when we then look at, why? Well, one of them clearly is that UK has an incredibly flexible labour market. And so when you combine that with post-financial crisis uncertainty, and by the way, this uncertainty spiked after financial crisis and not just after Brexit, then the logical thing for firms to do when they're facing just moderate and fairly uncertain demand growth is not to invest in big pieces of capital equipment, but actually just hire a couple of extra workers to take care of that extra demand, because they can always fire those workers if they need to. And that seems to have been a very significant driver of, the shift to more labor and less capital, and therefore lower productivity. Now, if we look forward, there's obviously not very much, in my personal view, that one can do about policy uncertainty as a kind of policy lever. And so what can be done, though, is some of the underlying problems that have been around for a long time. And our particular focus in our research ended up being around human capital and the degree to which, building up our human capital for the future, regardless of what happens with Brexit, regardless of anything else really, and regardless of technology, is kind of a no regrets thing. And so that's what we probably still would conclude. And it's not just education, it's also people who are already in the workplace, which will be critical going forward.
And that maybe these graduate apprenticeship schemes will have some impact there, since a lot of universities now see them as a money spinner.
Well, I think my challenge with most of the policies and, let's say, the industrial strategy is that we have 35 million workers here in the UK. So if we get, 5,000 extra graduate apprenticeships, I'm not entirely sure what difference that'll make.
Yeah, pretty marginal. Rebecca.
I think it is very instructive to look below the aggregate data if you are trying to explain what's been going on. And the UK does look very stark, like you say. I guess, if you look at relatively detailed bits of the economy, so different sectors, you do find that there is this broad-based slowdown in productivity. And of course, what that means is that there's some aggregate explanation. There has to be some aggregate explanation. And one of the interesting things, which I'm not entirely sure how one should interpret, but if you look at the sectors that have slowed, or productivity growth has slowed down the most, they tend to be the sectors where the UK is most competitive. So these are the sectors where the UK was doing really well in the 2000s, including finance and IT, etc. But if you just look at sort of the trade deficit and look at the productivity growth slowdown, there's a noticeable correlation there. And we of course know that trade collapsed after the financial crisis and didn't really recover for quite some time. So I guess I just wonder whether there's some of these macroeconomic explanations that are worth exploring a bit. I don't have an answer to what that particular mechanism would be, but there are some patterns in the data which I think are pointing to, we hate to say aggregate demand at this point after all this time, but nonetheless remarkably indicative of those types of things. But there are, although this slowdown is broad-based, there are also some sectors which are particularly have done particularly badly, like the finance and the IT. And I think one of the things I think is worth pointing out again is this issue about measurement being a particular issue in these sectors. So we're seeing the biggest drops in productivity in those sectors where we know we're not very good at measuring productivity. Productivity is bad or difficult to measure generally, but in these sectors, finance, there's reasonable explanations for why the way that productivity gets measured, you would sort of exaggerate the slowdown in that sector, and with IT the same. The other thing I would point out is, and it partly relates to the longer term slowdown. So there's been some studies in the United States looking at the reallocation process amongst businesses and suggesting that that sort of clearing out of low productivity businesses and making space for high productivity growth, or for firms who can do better to grow, that process has maybe slowed down a bit. And I think,
reallocation is simply slow productivity firms going bust.
Yes, and
disappearing.
The high growth ones having space to grow,
they're
basically.
Reallocating themselves, as it were.
Yes, so it's just sort of how the business population changes. So it can either, what's happening within companies or what's happening to aggregate productivity through the shifting of the population. And we see a little bit of that in the UK, although it doesn't explain a lot of what's going on. Most of what's happened is actually within businesses. But there is, if we look at certainly the financial crisis that we had, there does seem to be some evidence, certainly in the research that we've been doing, that some of the banks that went bust basically supported zombie companies and they didn't die, and also maybe some of the high productivity companies weren't able to refinance their capital. So there is some evidence that there's this link between having a financial crisis and then this slowing down of this reallocation process, which would affect aggregate productivity as well.
Nick, have we covered all the points, or have you anything?
No, I've got several more.
Okay.
Starting with disputing what some of my colleagues have said. It seems to me if you look at this slowdown from a growth accounting perspective, there's no doubt at all it's dominated by TFP. It's total factor productivity. Looking at numbers I calculated recently, but Jonathan Haskell has done the same job essentially. TFP growth on a standard way of doing growth accounting was about 0.9% a year pre-2007. It was about minus 0.8 between 2007 and 2016, 17. That's a very big change. Capital deepening certainly slows, but it doesn't go negative. I make the capital deepening contribution to have been about 0.9 pre-2007, about 0.4 post-2007. So capital shallowing was not what we saw. It was a slowing down of capital deepening. I wasn't quite sure what you were saying, Nick. And the Van Reenen study, which you mentioned, I think is seriously out of date, and it's been superseded by stuff that Nick Alton did, which in particular measures capital using capital services rather than capital stocks, which is quite important, as it turns out, in the British data. So I would want to reassert that it's a TFP thing more than anything else, if you do a conventional growth accounting approach. If you think on, sort of, in a way, expanding from terror, I wrote a piece 3 or 4 years ago which tried to answer the following question. Do you believe supply-side policy has actually got seriously worse since the financial crisis began? As it were, leaving Brexit on one side, taking that not to be a conventional supply-side policy. So you'd go down the sort of, though it will have some big supply-side effects. If you go down the standard list of things which Tara partly mentioned and so on, we look at traditional weaknesses and strengths in British policy. I would agree strongly that there have been weaknesses in innovation policy, weaknesses in infrastructure policy, weaknesses in, call it human capital policy, if you like. I think on the whole we've had relative strengths in competition and regulation, which we've probably done as well as other OECD countries, maybe better than some. I think that picture is largely unchanged. Certainly through the coalition government, I don't think we saw much change, nor recently. So again, if you say, I want to explain the slowdown, rather than simply to say that British policy is deficient, British policy was deficient before the slowdown started. And I think it's quite hard to tell a supply-side policy deterioration story. What would I go for? I'd go back to my unprecedented, and I think this goes across what colleagues have said. I think we've had, let's use journalese, something close to a perfect storm. We've had at the same time the combination of a big financial crisis that we haven't had in British economic history before. We didn't have that in the 1930s at all. Plus this change in the technological era, or the waning of a growth phase, and now added to the end of this, what Nick was talking about this morning, namely Brexit uncertainty, which I guess amongst other things will further affect the capital deepening contribution, as well as having a TFP implication. I think if you go through the literature and say, what does it tend to say would be the effects of a financial crisis of the kind we went through on the expected level of productivity 10 years after, or something like that, answer probably at least a permanent 5% reduction in the level. That's Nick Alton's kind of estimate. If you look at the ICT contribution through growth accounting, I would take that to have slackened very strongly since 2007-8, linked partly to the financial sector, admittedly, but that adds up to 8 or 9% as well, compared with what you would have expected before. And I'm not quite sure what to add for Brexit, but there's something there. So it seems to me we wouldn't be telling a story of policy deterioration. We'd be talking about a story of a much more difficult environment with which to deal in the last decade or so.
Now, I want in a moment to see if there are questions from the audience. Before I do any of you want to come back on any of the points that any of the others have made? This is the moment for challenge or argument, if you want to.